Good morning, everybody. Welcome to the morning call. I'm Laz, filling in for Scott this morning on a Friday. Well, let's see. We're starting with another gap down here on this news out of JP Morgan and their trading losses. Before I get into the charts and the indexes and all the stuff we generally cover here on the morning call, I do want to say that as a trader and someone who's been doing this for a fairly substantial amount of time now, what we do and what we preach is all about understanding and analyzing risk. And it's unfortunate, it's genuinely unfortunate that the vast majority of Wall Street doesn't really understand that concept. And I think it's a testament to where we are, with all the smart people on Wall Street. And again, I'm not generalizing and I'm not putting everybody into that category. There are a lot of very smart and ethical and high-level people, but it's the few that gamble and take risk, above and beyond what they understand, that generally, make us all look really bad. And that's unfortunate. I wish that some of the traders at some of the bigger banks took our active trading course, because what our active trading course really does teach you is how to understand, analyze, and mitigate risk. And it's unfortunate that Wall Street just can't get that right. So with that said, let's take a look here at the S&Ps and how the markets are reacting and how we can trade and anticipate future price movement. So let's jump right into it. Here we have the S&Ps. We're going to take a look at the spiders, our ETF for the S&P 500. And what we've seen here is this, sell-off that undercut. And again, this is the short-term picture. This is just your short-term chart. Going back here, you can make the argument we've broken, this sort of slightly upward rising trend line that the market's been in since basically the beginning of the year. We undercut that trend line 2 or 3 days ago. 2 days of consolidation here. We snapped back yesterday. I said earlier in the week and even into last week, we'd have a lot more resistance when our key MAs, our 21 and our 8 here, start to coil and hover over the price. Just like back here when we were in this uptrend, these key averages were trending and railroad tracking and upsloping here. They kept this trend firmly intact. Well, if this is going to amount to more downside, you're going to see these averages, start to hover over the S&Ps and start to push us lower. So what does this mean? Well, from a technical standpoint, you could make the argument you have a little bit of a head and shoulders pattern. This would be the top of the head. This would be your right shoulder. This would be your left shoulder. This pattern short term basically tells us we could break lower, and this would probably be the ideal spot. This is basically a one-day bounce, a retest of this broken trend line. And we could see down to the 130 mark. That's still, a fairly substantial distance lower in the S&Ps, which would really essentially, if we look back from the December lows or this rally, retrace probably about 50%. You can see this 50%, 62% retracement area, 131 down to roughly 128. So somewhere in this area, basically this is going, we anticipate this to trade down to that area. This has been a little bit of a more difficult trade to the downside, only because you can see that although price has declined, you can see that we have gap down. Again, this is going back into earlier this week. We gapped down. Intraday, we traded higher. We gapped down. We traded higher. We gapped down. We traded higher. So while price is actually declining, intraday, you're seeing buyers trying to step in and support levels. So that's making this sell-off a little bit more difficult to get involved with. Ideally, you want to get involved with price into the averages. So, yesterday's rally up or bounce or gap up or whatever you want to call it into the averages, probably a better place for the short sellers looking to potentially get involved here. Again, shorting is a very, very, I guess it's a more difficult approach to trading. You really have to understand the technicals to get best execution. You never want to short lows. You want to short a bounce. Just like in a bull market and a rally, you don't want to buy highs, you want to buy pullbacks. It really is the same concept. And for those of you that are new to that or don't really understand shorting, it is somewhat of an art form and does need to be understood. You do have to understand, though, that in a weak tape or a tape that is selling off, there is a lot more panic in it usually. You'll see things happen a lot faster. Stocks will break down in a much more rapid amount of time than they will rise. What can go up over a course of 6 months can unwind in a matter of 2 days. We've seen that time and time again. So understand that while they say you can't time the markets, unfortunately that's completely wrong. You almost have to, especially in today's trading environment. I have a whole bunch of stocks I want to look at, so let's jump right into some of the stock specifics. We're going to start and we're going to look at our benchmark. We're going to look at Apple. Apple really, to me, the tone, the tone and the pace and everything about the way the stock is trading right now, to me, lends to more downside. There's really no buying here, even over the last 2 or 3 sessions, as we've slightly traded higher off of this 560 low that we saw here on, I guess it was Tuesday. We did get a little bit of a bounce from 560 up to the, we saw maybe into the mid 570s yesterday, but there's no buying. There is absolutely no buying happening here. So this to me lends that it does want to go lower. I do suspect we will undercut this pivot low at 555, on this next potential leg down, snapping again into this declining average where we saw some rejection happen yesterday at or near that average. So that's generally a sign that, although we might, hover for another day or two, I think the stock's actually gapping down $5 or $6 pre-market here. So we have to keep an eye on Apple, as it is our staple, and if Apple goes lower, as I've said for a long time, so goes Apple, so goes the market. It is our, most heavily watched stock. There is room to go substantially lower here. So be aware, be careful, and understand what price is telling you. Over the last 2 days, the stock had a nice opportunity to try and, catch a bid and buy or step back in, but there was really no volume. There was no driver, nothing here that speaks to, about committing fresh money or entering a long trade here. So keep an eye on that, as I do anticipate lower prices in the cards. Moving along here, Chipotle. I talked about Chipotle in the morning calls last week. We broke this, bear flag. We traded down. We took out this prior pivot low. Little 2-day snapback again here into the average. Probably going to be an area for some short sellers to look to, re-engage on the short side, as this is probably a stock that, could potentially see lower prices here. Again, one of the tools that I like to use in terms of evaluating targets is fib extensions. If you're not familiar with how this works, again, it's just basically it's using prior historical price to anticipate future price. One of the things we teach here, one of the tools we teach in our active trader program. So we could see down to the 100% extension, which is the low 380s, and potentially even further. Now, that's not going to happen in a matter of 1 day or 2 days, but keep an eye on this, how the stock reacts here into these what are now declining averages, the same way it reacted here into rising averages during this uptrend. You have to respect the movement of price and understand what it's telling you when something has changed. Our leadership, if I could just make a general point here, our leadership, what led us higher, eventually will lead us lower. And the leadership structure has changed. We can look to our leaders of Apple, Priceline, Chipotle, MasterCard, Gold. These things are not necessarily acting well. They're not showing any strength. So these are going to be the things that takes the market lower. So keep an eye on them. We're going to look at Priceline post earnings. Priceline, definitively has this, you could argue a double top into the 750, 760 area. We've come back. We are now, at prior support level. This is the last area that we bounced. I do think we are actually probably gapping down. Again, you don't want to short or chase a gap down. You want to basically look to get involved. I do suspect you will see possibly a couple of days of maybe a bounce or some short-term consolidation, but keep an eye on Priceline, as we could very easily get into this gap down here around 600. You can see this open gap back here from late February. That to me is probably where the stock is going, and even the 200 EMA down here, right around 590, 600. So with time, I think there might be a better entry on the short side, but I will look at Priceline in the days ahead. Stock looks like it is breaking down, and it has undercut its most recent trend line. So generally, when stocks break their trend lines, it's usually a sign that this party is essentially over for some time. So don't go bottom picking here. It's probably not going to be a safe trade. We're going to pop over to gold, GLDs. In last week's Stock Twits Q&A, so I got a question about the GLDs, and I basically said, look, there's really nothing compelling technically going on here. There's probably not a reason to be here long. Gold's been a very, very good trade for a very, very long time for a lot of people. You can go back and look at your weekly charts, and and I know Scott talked about gold for a long time, from 2005 to basically 2011, the beginning of 2011. It's been a very, very profitable trade. That to me has somewhat ended here. We failed to make new highs. We probably should have made new highs. This is a weekly chart. Gotten back above this, pivot here, 175. Starting to turn down, and if the GLDs undercut this low, you could see some heavier bout of selling. This low comes in right around 148 in the GLDs. So gold to me looking like it's starting to break down and wants lower prices. So be careful there with gold. MasterCard, go back to the daily chart. MasterCard, seen a nice wave of selling here. Nothing I would get overexcited about. I don't necessarily know there's a trade here, but you can see our key MAs again with the market starting to flatten out. The stock has retraced. We broke out to new highs, and then, now we're back down into support. So keep an eye on what MasterCard does over the next couple of sessions. We could get some choppy, sideways action, possibly even a little bounce, but something on the radar just to watch, as it has been a staple of leadership for a while. Lulu, another stock, in that retail space that's been acted so well. Again, nothing's going to perform that well on the long side if the market's selling off. It's a much harder trade. There'll be stocks that may not break down, but they don't necessarily make any forward progress. So, if the market really starts to pick up steam to the downside, and it very well may, just understand that trying to buy stocks is probably not going to be an effective use of capital, and wait for the market to sort of subside, or maybe put in some short-term low, and then you'll be able to determine where the relative strength trade may be. Lulu to me, another stock that broke out here on the chart through that 76 level and some good volume, but also failed very hard, and you can see that failure came up on good volume. So the trade here, depending on the type of trade you are, if you're an active shorter term trader, we might be setting up for a short trade, another move down here. Support would come in around that $70 mark. If that's not really your bag or something you fancy, it's probably best to be in cash or step aside here. Would be my recommendation. And another stock that I want to cover, not something we've talked about in a while here, is Research in Motion. Stock that's been left for the dead everywhere. Technically, headline driven. There's really not much, when you read and see headlines about Research in Motion, there's really not many positive things happening here with this company. And the chart's been a reflection of that for a long time. As this market has made new highs over the last 2 years, the stock has consistently made new lows. So there is a massive outflow of money. It's been that way for quite some time. And it looks to me like it's setting up for another potential leg down. This stock, possibly could see down into the, sub 10, even the $8 mark, barring any, corporate headlines. Basing down here, we saw a heavy volume breakdown, over the last week or so, just sitting at these lows, waiting for these averages to probably catch up to the price of the stock and then, drive it lower. So for those of you that are looking for something of a little bit, maybe a cheaper stock, not high beta, RIM could be an animal you might want to look at if you're looking for a potential short sell for a trade. I suspect this could see, like I said, sub $10 in the not too distant future. So, really sort of just a random walk around Wall Street. I tried to cover a couple different key leadership stocks that have the structures have started to change, as well as the S&Ps. Again, this isn't a tape where you just want to blindly get long and hope for the best. If you were around in 2008, and I'm not saying that what's happening now is the same thing that's happening then, but the concept is the same. Selling is selling, and selling generates fear and volatility and a little bit of panic. Even if it is a correction or a pullback, again, I'd rather be a buyer when price, when my averages flatten out and something tells me it's now safer to be involved. So if you're just blindly throwing money and hoping that you get a bounce or this market bounces, you're probably going to be in for a very rocky road, and it's going to be a very, very unsettling type of trade. As always, risk is key. If you're a trader, then you're a risk analyst, and if you don't fancy yourself that way, you need to think about what you do a little bit deeper. As always, a planned trader is a profitable trader. Have a great day, and I'll talk to you on the VTF.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.